What is up, How to Buy a Homies? Today we're going to tackle the home loan. And in the end, you'll discover that what you really need is a unicorn realtor and lender combo. It's not just about finding a special realtor to help you. It's about finding a special realtor and lender who work together. A unicorn lender can totally be a game changer. And you'll learn about how shopping online when you're just looking at the interest rates, trying to pick your lender, that can be a losing strategy. Homies, avoid the bait and switch. Avoid the click here to get pre-qualified spam machines. Avoid the button-clicking bots online. Avoid those order takers. When you listen to this interview, you're going to be blown away by the insane insights and options that you can be shown when you're working with a real-life human partner. You're going to learn the difference between a pre-qualification phone call and application that can be absolutely intrusive versus a discovery call that helps you simply see where you're at right now and then help you formulate a plan for the future. You're going to get real clarity to help you to be able to differentiate between hard and fast loan rules versus what might just be loan guidelines, which are not always set in stone, even though you may have been told otherwise. And how about getting some information on interest rates from an actual expert in the industry? Or some nice truth bombs about being able to buy a home with debt, including that pesky student loan debt. And we even get into how you pay your taxes might be able to be used to your advantage when you're looking to buy a home. And my favorite thing was, if you think it's too early to reach out, because I hear this from people all the time, they say they don't want to bother the lender. Well, gang, once and for all, from an authority, stop it. Stop it right now. When you're looking with a unicorn lender, Kelly said it best. It's not a bother, it's an honor. All right, let's hear the interview.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
Hey, homies, I am super excited today. It's time to talk to you about home loans. Now, I know I tell you all the time, you need to go out and get your team, get your realtor, and then have your realtor refer you to a lender so that you have that advocate wonder twin power happening. Whoa, I dated myself with that reference right there. I am old, drink. So what I've decided to do today is, you guys know the way the unicorns are. They go through a very strict vetting process for me. Well, as a guy who has a podcast that has millions of listeners and they're all first-time home buyers, you can imagine that my phone is ringing off the hook with lenders calling me, say, hey, I want a piece of those people too. That's the scummy part of real estate that I tell you guys about all the time. So here I am 6 years later, and I've got one national lender that I refer to my clients because Kelly is here today. And she is with Guild Mortgage, and they're national. But Kelly has built her entire relationship. I've known her for decades. Well, a few. And she's built her entire business through the relationships. And she's been my partner side by side building How to Buy a Home. And we're going to talk to you about home loans. So let's get to it right now. Kelly, how you doing today?
I'm doing good, David. Thanks so much for having me on today. So good to see you.
It's great. You go, guys, if you could only be a fly on the wall for the discussions that Kelly and I have behind the scenes. We're just dying to make sure that your first-time homebuyers do the right thing. So I'll start right away with, let's start giving them the knowledge nuggets. Home loans. Everybody has a million questions. What's one of your biggest tips for first-timers who are coming in blind?
Yeah, my biggest tip is to schedule a discovery call and learn what you need to know specific to your personal financial situation so that you can create a plan and then execute the plan. Make it simple. Right now, a lot of people walk around thinking they have to wait for this or that, but they really don't know because every single loan is a case-by-case basis. There's guidelines for underwriting, and they're called guidelines for a reason. They're not hard and fast rules. They guide the decision-making process. And as long as we're not putting you in a situation where you can't afford the payment and still live a quality life, very likely we're going to put you into a home. So you don't know this And ChatGPT is not going to know this either, you guys. It's a fantastic tool and it speeds up our knowledge, but it is not all knowing about your personal financial condition. So best thing you could do, schedule your discovery call and educate yourself on your own individual plan to get into a home. That's my best tip.
Before I get into the next questions, I'm going to talk about a couple things about that. Number one, a discovery call. When the homies go online, they see everywhere, hit this website to get pre-qualified, hit this website to be pre-qualified. What's the difference between a discovery call and finding out if you're qualified to buy a mortgage?
Yeah. Okay. So click here to get pre-qualified. They want all of your income, your assets. They want to pull your credit. They want you to upload your pay stubs, W-2s, bank statements. It's like marrying someone on the first date. Really what a discovery call is a fact-finding mission for you, for us. The more we know about your personal financial situation, we'll ask you, what do you have in the way of monthly payments that you pay out every month? We're not going to pull your credit this first conversation. We're going to find out what you have in the way of a savings account, or if you have any family that's chomping at the bit to give you money for a down payment. Those gifts are turning 5% down into 20% down overnight with one conversation. And we don't know that until we talk about it. We talk about your income and learn a little bit about how your income's structured. Is it base salary? Is it hourly? Do you have bonuses? Do you earn commission? All of these income categories are treated differently. So we help you understand how your income's calculated for qualifying reasons. We're also going to look at your gross income versus your net income. And we can get into that more as this conversation evolves, but there's a difference. And it takes somebody who knows what they're doing to help you figure out how much you can afford in your new housing payment.
Okay, I love it. We talk all the time. I actually heard from someone a long time ago, if you want to have a relationship with your parents, start a podcast and interview your parents. And I heard some guy do it. He interviewed his dad. It was the coolest thing. And it's a deeper level of conversation. Kelly, you and I talk all the time. We've been talking about this and building a Last Lease Ever program for years. And that was such a great explanation. So that's the difference. Someone else comes in and thinks that they give the paperwork and it's automated. So explain the difference between rules and guidelines one more time, because for those of you who don't know, guidelines, that's what we use in the industry. The lenders and the people that they're shopping your loan to, they have guidelines. What's the difference between that and a rule?
So a rule is black and white. There's no gray area. There's no room for, yeah, but I'm getting this. Or, yeah, but that's going to be paid off in 10 months. As a matter of fact, a lot of people think they need to come to us having no debt at all. But the truth of the matter is certain investors allow for you to pay down, let's say, an auto loan down to where you only have 10 months left of payments. And then we don't have to count that payment in qualifying you anymore. And
wait a minute. I'm interrupting you because so if it gets below 10 months, they act like it's not there?
Yes.
On your debt to income ratio?
Yes. Most investors, not all of them, most of them.
That's incredible. So that would mean if your car payment's $500 a month, then suddenly when you're like, I need $5,000 more and we'll be right there. Now you're there.
You're there.
That's incredible. Okay, I'm sorry, I interrupted you. Guidelines and rules.
All good. So yeah, the guidelines allow for these types of situations. Guidelines also allow for a higher debt versus income ratio, debt to income ratio. When you have incentive compensation, such as bonuses or commissions, and you've only had them for 18 months, the guidelines typically require a 2-year average. But if you've had it for 18 months, then we might be able to allow your debt to income ratio to exceed 40, 43, 45, even up to 50%, because we know you've got this incentive compensation that we can't technically use in your qualifying debt to income ratio, but we know it's there. We can see the trend. Sometimes we'll ask for the last 18 months of incentive compensation or commission reports so we can see how your commission's been increasing as you're performing more as a salesperson. We see this a lot. So that's a compensating factor for a higher debt to income ratio on the income that's allowed to be used in the qualification versus the income that's not seasoned. It's not 2 years of incentive comp, but it's there and it's growing. That's a guideline we can get in a gray area and push the debt to income ratio a little further, because fast forward 6 months, we can use it in the debt to income ratio. If you're only 18 months in, technically we can't use it, but it is a compensating factor for pushing past that guideline of 45% debt to income ratio, or whatever the investor requires as a maximum. Every investor is a little different.
Yes. I think the overall understanding with that is that's just one. I know there are a million different things you do this. We're talking about self-employed people, and we're talking about people who are getting income from different places. There's a million different things that will fall into that gray area. And the moral of that story is, if they just saved on their own and they called you thinking you were going to punch in their numbers and give them a yes or no, black or white, am I approved? Maybe they would have been, now they only have 6 months of car payments left. Whereas if they talked to you 12 months ago, when they had 16 months of car payments left, then you've got 6 months of working together, because it's a discovery call, not a let's go buy a house call.
Exactly. And if you're not ready today, we're going to help you figure out what you need to do, like give you a prescription for your own personal financial condition to get to where you need to be to feel comfortable. Just because you can doesn't mean you should. Like if we tell you can buy today, but you want to have an extra 10 grand, okay, great. Can you save $2,000 a month so we can do this in 5 months? That's your plan. You create your plan with our guidance. And if you're just plugging in these numbers, you don't know that you shouldn't use your auto loan payment. We ask these questions in the discovery call, and then we educate you through the process.
So having a podcast and being a cringy old dude, drink one more time, I find that a lot of people that call me are just really nice people because they tolerate me. So they must be very nice. And many of them say, I don't think I can call a lender yet. I don't want to bother them. What's your answer to that?
Oh my gosh. So it's not a bother. It's an honor, really, to be your guide through the process. So we don't take this lightly. It is an honor and a privilege to be able to help people strip down naked financially, like really, like, there is nothing to hide. You can't hide anything. Back in the day, you used to be able to state income and get loans that you couldn't qualify for, and the market turns, you lose your house. That's why you can't do that anymore. So it's very vulnerable. Everybody has a relationship with money. We don't take that lightly. We handle that very gently. We're here to meet you where you are and help you understand what it's going to take to get you into this home. So it's not a bother. It's a privilege. Allow us to be your guide in the journey. And this is just the first part of our relationship. We want to help you buy the next home, and the next home, help your friends and family. We want to be the resource that your community, your local community, trusts on your word, because you did it. If you can do it, they can do it. And that's who we are. We want to help you. We want to help you figure it out. And it is not a bother.
The big difference between the big online lenders and a relationship built company like Kelly's team at Guild is that they're attempting to capture you, make another notch on their belt, and close the deal. Where Kelly and all the unicorns are seeing a lifetime of working with you. And that's why working with you early is not a problem for them and absolutely not a bother. It's what we do. Right before we turn on the microphone, Kelly and I were just having happy thoughts, talking about, I interviewed someone a little while ago who was just raving about working with someone on Kelly's team and how great their unicorn lender was, helping them feel like they could get to the finish line. Kelly, one of the big questions that a lot of people are talking about right now is there was a big hold of buyers who didn't go in the market when the interest rates went from 3% to 8%. We're slowly starting to see people re-enter. On your end, what are some of the reasons that you're seeing people come back into the marketplace, even though the interest rates are still, 6.5%, 7%?
Yeah. So I just want to make sure everybody realizes that 3% and 4% was a false market, and it was a gift. And we're all repaying that gift right now, by the way, with these higher interest rates. Now, these aren't high interest rates. These are normal interest rates. We've just been spoiled for a couple decades with these ridiculously low subsidized interest rates to stimulate the economy. Those weren't real, but we got used to them. We got spoiled and slightly entitled, quite frankly. And at this point, buyers who were expecting rates to come down to 4% or even 5% realize that isn't happening anytime soon, but they're watching the home values go up and up and up. Even if it's only 3 and 4%, that's all appreciation you're losing because you're not in the market. As soon as you buy a house, you get to start feeling that appreciation. So we're seeing people wake up to the fact that 3 and 4% is not coming back. It's not. Unless we have another terrible, terrible thing happen and the government decides to subsidize the economy again, then we might see something close to that, but we're not going to see 3 again, you guys. We're just not. I would say mark my words, but you know what? I've been wrong before. Who knows?
Well, we had the recession in 2008, and then we had COVID, and things have had to react to those things. But it is the last 40 years. It's 7.7%, I think, is what it is.
Yeah.
Because I always remember that. And so with this, a lot of people will say the high rates kind of became the straw that broke the camel's back for them to even stop asking questions. Well, we've taken care of the first part of that. When they find a unicorn lender like you can ask questions 12 months, 18 months, 2 years ahead of time. So the second question is, okay, great. So I'm not going to let the rates scare me, but I have big student debt. I have lots of debts. Can you still buy a home when you have debt?
You can. Okay, but before we get into debt, can I go back one step back, because there's something I really want to share. Is that
welcome to my conversations with Kelly, everybody. This is what we do.
We grind on stuff just to make sure we totally flesh it out. So
go for it.
Another reason why buyers are entering the market is because of all the fence sitters that aren't in the market. There are fewer buyers in the market right now, and sellers still need to move. They still need to sell. So we're seeing credits show up. Certain markets have never really slowed down. Super tight, super fast, lots of competition. But the majority of the markets across the country, there are fewer buyers. Sellers are more interested in giving you the opportunity to do inspections, ask for credits or repairs, pay some of your closing costs, temporarily buy down your interest rate maybe. There's all kinds of different options where it used to be a seller's market. Now it's getting a little more balanced where the buyers have a little bit more negotiating power. And these unicorn agents we've been working with, you've trained them very well to help people understand when to ask for credits and when not to, because they do the reconnaissance, talk to the listing agent, find out what the seller's hot buttons are. Is it a fast close, or do they need to stay in the place for 2 months? And they're smart, they're educated, they write the offer to be a win-win. So we're seeing a lot more buyer opportunity to negotiate. So these buyers are getting back into the market. So thank you for letting me add that piece in, because I think it's important.
No, that was great, because what you were talking about was the fact that the people who were getting re-engaged were the people who either realized that those rates aren't coming back, or they had just a life moment, a season, a chapter, and they're just going to move on because they just think it's not going to go back down to 4, like you said. But now we're getting to the place where there's a little bit of that incentive. It's not making the news, but the sellers are giving concessions. They are giving credits, or maybe just the price is negotiated in a better place for the buyers, because most of the people are scared. Is that what you're saying?
Yes. A lot of buyers are afraid. I'm going to wait and see what happens with the economy. Well, the fear there, like you could be fearful for doing it, fearful for not doing it. Choose your poison. Pick your poison, because you're missing out on potential appreciation. As soon as these rates stabilize, when inflation comes down, there's talk of us being actually in a recession right now, and the numbers just don't show it yet. The Fed may be forced to reduce interest rates at a faster clip than what they've said they're going to do for this year, and that could drive interest rates down. Now, the Fed doesn't move mortgage rates, and that's a whole conversation in itself, but they impact the market which moves mortgage interest rates. So when the Fed makes moves, typically rates fall in anticipation of that fall, and then maybe shortly thereafter. So I just got a little off track there, David.
No, that's
Bring me back in.
The homies know that, because my last current market update, I did the connection between the 10-year T-bond and when the Fed reduces to the 10-year T-bond, which is usually tied to loan rates. If you don't know what I'm talking about, go back and listen to Monday episodes for March and April, because that's where I explained all that. I think the big thing, I know the big thing is this pent up demand. It doesn't matter to you guys out there, but Kelly and I have been watching how few people are buying homes. It's usually 5.5, 6 million sometimes. We're at 4 million transactions a year for the last year, and probably for this year too. That means a lot of people, and we're still making people.
Yeah.
So it's not like people don't need homes. So there's a lot of people that could have moved, should have moved, and they haven't. And as you who listen to the podcast all the time know, the one thing that's going to affect those home prices is low inventory. And when the inventory releases and people come out, I don't know. I used to think that home prices were going to skyrocket. I think we're at a weird affordability place right now, but the appreciation will continue because we have the low inventory and the pent up demand. So let's help people get over their fears.
Credit.
Great segue, by the way, or great tangent, by the way. And yes, it was a great segue by me. I'll pat myself on the back. How do you buy a home with debt? Can you buy a home with debt? I have $200,000 in student loan, Kelly. That's why I'm not calling you.
Oh my gosh. So a lot of people come to us with the concern that they owe too much money, but they think they owe too much money, but they may still be able to buy a house. Just keep in mind, like, that rent is going in somebody else's pocket. So even if your housing payment goes up from $2,000 to $3,000, yes, it's more money out of your pocket, but a portion of that is going into your equity. So that's, every time you make a payment, your loan balance goes down. And over time, your home value goes up. That's called, increased equity. And that's going straight to your bottom line net worth. Homeowners have 49% higher 49 times the net worth of renters over time. So
49 times.
49
Do that graph in your head.
It's a lot. And then the tax benefits add a whole other element. So many people come to us and we say, okay, I'm not a tax advisor. Don't crazy to take tax advice from me because I pay somebody to advise me. But here's what I know. Mortgage interest and property taxes on your primary residence with some limits are usually tax deductible. That means you're reducing your taxable income, giving less money to the IRS, giving you more cash flow in every paycheck to be able to swallow up some of that larger payment. So back to I have $200,000 in student loan debt. Usually student loan debt is based on your income, like a income-based repayment plan, where that payment is going to be affordable based on your income. So we help point you in the right direction to figure out what that payment's going to be. If you're coming out of forbearance, you don't know what that payment's going to be, we'll guide you on who to ask that question. If you're in forbearance, you got this $200,000 worth of debt, most investors allow us to use a conservative fraction of that outstanding balance as a fictitious minimum payment, because we know you're going to have to pay it back at some point. So some investors allow us to use as little as 0.5%. So 200,000 times 0.5%, that's $1,000 a month. So we would calculate $1,000 a month into your maximum debt to income ratio as a fictitious minimum payment someday when you come out of forbearance.
So breaking it down, I have 50,000, 100,000, 200,000 in student debt. You're saying the bank isn't looking at my gross totals?
They're not looking at your total outstanding amount of debt owed. No, we just look at your minimum monthly payments. And if you're in forbearance, there is no payment. So different investors require you to use a different factor of the outstanding balance to create a fictitious future minimum monthly payment. Now, usually that amount is even higher than what your income-based repayment is going to be calculated by your student loan administration that's administering the loan. So that's why we say, call them, see what your minimum payment would be if you were out of forbearance. Then you can give us that documentation. Let's say that it's only $500 a month. Now there's another $500 you can put towards your new housing payment for qualification. That make sense?
Oh, it absolutely makes sense. But Kelly, you're going to appreciate this. I understood. I have checked out because I think the name of my new band is going to be minimum monthly, no, future fictitious future minimum monthly payment. That's the name of my new band.
That's a mouthful. Sorry.
Yes.
Oh.
I mean, I set you up on that question. Obviously, I've talked about gross versus net a million times on here. But it's so great to hear from you, from a loan professional, because you do this every day.
Well, and should we talk about net income versus gross for a second for loan
Totally.
qualification purposes? So
Yeah.
a lot of times in our discovery call, I'll say, okay, how much money do you make? Well, I take home XYZ. Well, okay, that's awesome. But we're going to qualify you on your gross versus your net. And the reason for that is because a lot of employers offer optional services that can be taken from, pre-tax dollars contributed to 401ks and such. Your health benefits sometimes will come out pre-tax. So that's going to reduce your net income, but it still goes towards your qualifying income.
What if I don't have those?
If you don't have those, then it's not impacting your net, but we're still going to use your gross.
Oh my gosh. So my normal tax is taken out, not extra things taken out. You still go on my gross?
Always. We always go on your gross because everybody has different deductions that they choose to participate in or choose not to participate in. For example, if you're a married couple and one of you has great health benefits, the other one doesn't need them from their employer, so they're not going to buy them. So it's the net income would look different for those two people because one is paying medical benefits, the other isn't.
Yeah, and I don't think a lot of people realize that all those little acronyms on your paycheck that takes everything out of it. If you're a regular W-2 employee, those little numbers, those little letters that eat your numbers, that's what I should have said. You can choose to have those take nothing out. And then you just pay back the government instead of getting that $3,000-$4,000 refund every year. But so that's why you guys just go grow. Okay, so that's great because there are a lot of people who are going to come to you and they think take home.
Yes, a lot of times. And we talk about the W-4 form that you file with your employer to state your dependencies, what does any of this mean? What does any of this mean? It means how much is your employer going to pull out to pay the IRS and your local state tax if it's applicable. Some states don't have any income tax, but you're telling your employer how much to take out based on what you think you're going to earn in the year. And when you get that refund, you're doing jumping jacks, you're stoked, you got vacation money, but guess what? You just gave an interest-free loan to the IRS. They're just giving you back your money.
And that's the hardest thing for me to because I'm like you, I'm not a tax professional. I pay somebody. Mm-hmm. So the only thing I can do is give the hundreds of examples because the little sheet on the W-4 they give you the 0 to 9 to figure out what it is. I mean, it's applicable to no one except maybe the single, yes, I have a kid or whatever. But a lot of times people will take that paperwork to their tax person and their tax person will say, okay, based on your mortgage interest deduction, you can put a 3 in there and you're not going to owe anything at the end of the year because you're going to have the write-off because you're a homeowner now. Mm-hmm. And that can change people's comfortability. Come to something. Comfort level on their monthly payment. Because now maybe instead of claiming 0, they claim 3, assuming that the tax deduction they're going to get. Yes. And now maybe they got an extra $500 a month.
It's incredible. I have an example where I had a client coming to me thinking they could only afford $550,000 for the purchase price in a very high cost area. So, and it was very hard to find a $550 purchase price that was going to meet their needs in that particular market. And we did a worksheet's where you see what the purchase price, the down payment, the loan amount, the monthly payments, all the closing costs to figure out how much it's going to cost out of your pocket to get into this house, but also on a monthly basis. With the interest rate and everything, they took that worksheet to their CPA and they moved their comfort level of 550, which by the way, we knew they qualified for more. That was just their comfort level based on their limited knowledge of what they could afford, AKA, I'm going off my net income. This is what I take home.
Yep.
And when they brought it to their CPA, they moved their sales price up to $680, David, from $550 to $680 because
he explained to them the deductions they were going to get as a homeowner And they felt like, and then because of those deductions, they were going to have more net take-home money every month.
Because they changed their withholding with their employer, and the CPA, the accountant, the tax advisor told them what to put on their W-4 form. So they changed how much their employer was taking out of every paycheck, which basically gave them a net income raise.
Yes.
Now, they won't get a refund at the end of the year. Yay, why would you want the IRS to give you back your money? But they did get more in every single paycheck to be able to feel much more comfortable with that higher payment, with the higher sales price.
Now, we could continue to go into this all day. I'm going to tell you to go to howtobuyahome.com and ask David if you have a question. And Kelly and I will set up a time and chat with you, and we'll go over that because that is the high-level stuff that's in the how to financially prepare to buy your home 7-part series, which starts at episode 19. Because that's how long ago I did it. There was an entire episode dedicated to this. Hey, homies, this is David. This is an interview interruption coming from me right now. I hear from tens of thousands of you each year who are perplexed on the whole, how does this home loan and mortgage thing work? So having Kelly on the show, I got really excited about being able to get you all the information because so many people asked me about this. And the interview ended up going a little bit long. I was really excited for you to get this information straight from a unicorn's mouth. So I just kept babbling and asking her more and more questions. So I had to split this interview into 2 parts. So stay tuned. Part 2 of the interview with Kelly the Unicorn, that's going to be coming to you in a couple of days. Now, let's talk about what we learned so far. Man, did Kelly drop some knowledge nuggets. Let me reiterate a few here so that you can really grasp these concepts and feel very clear when you're making your choices moving ahead. First of all, don't get pre-qualified. Get a plan. Oh, I love that. And she talked about getting a discovery call. Now, what's the difference between a discovery call and a pre-qualification phone call to all the other lenders out there? A pre-qualification just equals a paper dump. You upload all your documents, they pull your credit, and then boom, they give you a number. But they don't know anything about you. A discovery call, it's a personalized strategy. There's no credit pulls, no pressure, just an honest conversation about income, savings, debt, goals. Your first phone call with a lender shouldn't be a marriage proposal. All right, this is like your first date. It's more like you're just finding out if you both like dogs before you go on date number 2. Another great thing she talked about was those guidelines versus rules. The rules, well, those feel like brick walls, but the guidelines, those have a window that oftentimes you can open. Kelly dropped gold here. She said if you've got less than 10 months left on your car loan, well, hey, that might not even count against your debt to income ratio. And if you've only had commission income, which a lot of people have that happen, and if you had it for 18 months, not the required 2 years, you know what? That might still work just like another 2-year person trying to borrow money to buy a home. And her biggest mistake that she talked about, don't wait until you're quote unquote ready. That's the biggest mistake. Not people putting their money in the wrong thing or getting the wrong interest rate or choosing the wrong loan program. She actually said it's people waiting until they're ready. Unfortunately, too many people, when they're getting ready to buy a home, they think that they need to clean up everything first before they reach out to a professional. So call those unicorn lenders 6 to 12 months early. Go to howtobuyahome.com and ask me, or go out and find your own. I don't care. Just do it early. The best people, the right people, they're going to build your custom timeline. So when you are ready to go out and buy a home, you're actually ready. And of course, we got the insights on interest rates. Unfortunately, gang, it's not 2021 anymore. 3 to 4% interest rates, that was a gift from the federal government. It's not normal and it's not coming back. These 6 to 7% interest rates we're looking at right now, this is the historical average. So what happens if you sit around waiting for better rates? You're likely going to be missing out on some key aspects that are going to help you get the best deal. You're going to be missing out on negotiation power, the credits you could get from the seller, the buy downs, the help with your closing costs. And if the market continues to go up because of the low inventory and the supply and demand, you're also going to miss out on the appreciation gains, the free equity, the free profit you make when you buy a home. And that can happen if you're sitting on the sidelines, still renting and not in the game. I love the fact she talked about buying with debt. Yeah, including those student loans. DTI, your debt to income ratio, it's calculated using your monthly payments, not your total balance of the loans. And another thing she talked about was that if your student loans are in forbearance, most lenders use a conservative estimated payment. And oftentimes that can be a lot less than you think. And hey, from personal experience here on the podcast, I've interviewed people with $300,000 or more in student loans. And it didn't mean automatic disqualification. In fact, they still bought a home. And there was some great information on the net income versus the gross income, figuring out how all that works with the after taxes and the 401k and the benefits, and maybe talking to a CPA to help you tweak your tax withholdings via your W-4 so you can increase your take-home pay. And you can do that before you purchase a home or once you're a homeowner because you've got new tax deductions. And I said it at the beginning, I'll say it again, my favorite thing. I don't know how many good qualified people say, I don't want to bother anybody. I don't want to talk to a lender. I don't want to talk to a realtor. I don't want to bother them yet because I've still got to get this stuff ready. Folks, biggest mistake that first-time home buyers make. Don't sit around thinking you need to clean things up before you talk to somebody. Talk to somebody so they can help you clean things up. What did Kelly say? Loud and clear. It's not a bother. It's an honor. People who love this job and who are happy to help people like you figure out how to buy a home, their favorite thing to do is to help you figure out that this is literally what we're here for. Literally used correctly. We are here literally to help you in the planning when you don't know where to start. Oh, I'm so excited for this. Part 2 is going to be coming up in a little bit. If you've got questions, you can't wait, go to howtobuyahome.com. Hey, I'm there just to ask a question. There's an Ask David button. Ask me for free. I'll answer it for you. And if you want a connection to a unicorn, awesome. If you want to listen and figure out how to go find your own unicorn, that's awesome too. Everything's there at howtobuyahome.com. Doing this because I love it. Doing this because 6 years ago, I quit my broker and decided I'd rather help people get things done correctly than have people get taken advantage of. Because I've seen people do it and I know how this works. And you know what? You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyahome.com to get started.